Welcome. If you are listening to this, it is because you are ready to stop guessing and start engineering. You likely know the basics of markets. You know what a stock is, you know what a chart looks like, and you perhaps know some basic Python. But to sit across from a professional quant at a hedge fund and hold your own, you need to fundamentally change how you view the price of an asset. We're going to move you from the retail mindset, which asks, is this stock too expensive, to the quantitative mindset, which asks, who is forced to sell this stock right now, and what is the mathematical probability of them stopping? We will divide this journey into three parts: the philosophy of constraints, the mechanics of forced flow, and finally, the mathematical architecture you need to build to exploit it. Let's begin with the philosophy of constraints. Most people believe prices move because of news or opinions. They think a stock drops because investors suddenly believe the company is worth less. In the world of high-level quantitative finance, this is largely incorrect. In the short term, markets are not moved by opinions, they are moved by rules. This is the single most important concept you must internalize. The biggest players in the market, banks, pension funds, and market makers, do not trade because they want to. They trade because they have to. This brings us to the concept of balance sheet capacity. Imagine a major bank not as a trader, but as a warehouse for risk. This warehouse has a rigid size limit determined by regulators, specifically something called the supplementary leverage ratio, or SLR. When a bank reaches its limit, it mathematically cannot take on more risk, no matter how profitable the trade looks. If you were talking to a quant expert, you would discuss this in the context of quarter-end dislocations. You would explain that as banks approach their reporting dates, they mechanically widen their spreads and pull liquidity to tidy up their books. This isn't fear, it is regulatory compliance. A retail trader sees a crash. A quant sees a temporary contraction of balance sheet capacity that must statistically mean revert once the reporting date passes. Now let's move to the mechanics of forced flow. To understand this, we must look at the risk management feedback loop. Most modern funds operate under strict volatility targets. Let's say a fund is mandated to keep its volatility at 12%. If the market suddenly drops and volatility spikes to 20%, that fund is mathematically required to sell assets to reduce its risk exposure. They are not selling because they dislike the asset. They are selling to satisfy a value at risk, or VAR, equation. This creates a phenomenon known as a liquidation cascade. One fund sells, pushing the price down. This lower price triggers the volatility limits of a second fund, forcing them to sell, which triggers a third. When you speak to an expert, you don't call this a downtrend, you call it a mechanical deleveraging event. You hypothesize that the selling is price insensitive and will overshoot the fundamental value. This also applies to the upside, primarily through index rebalancing. Think about the S&P 500. It is not just a list, it is a mandate. When a stock is added to the index, trillions of dollars of passive money must buy it at the market close on the effective date. They don't care about the price, they need to minimize their tracking error. As a quant, your job is to model this impact phase. You're looking to front-run the flows of these blind giants who have zero price sensitivity. So how do we turn this theory into code? This brings us to the mathematical architecture. You cannot model these constraints using simple linear regression or basic technical indicators. You need to use specific stochastic processes. When talking to a pro, you would mention the Ornstein-Uhlenbeck process. This is the standard mathematical way to model mean reversion. It describes a price that has a magnetic pull back to a central value. During a forced liquidation event, the rubber band stretches. Your model calculates the tension in that band. You would also discuss the Hawkes process. This is a statistical model used to predict the arrival of events that cluster together, like earthquakes, or in our case, large sell orders. It helps you distinguish between a random sell order and the start of a cascade. Finally, we must discuss the technology stack, specifically the system you are building with large language models and RAG, or Retrieval-Augmented Generation. A true quant system is not just a script that downloads prices, it is an ecosystem. You are building a pipeline where Python reads complex academic papers and quant textbooks, converts that raw math into clean LaTeX code, and stores it in a vector database. When you ask your AI agent to build a mean reversion strategy, it is not hallucinating code from the internet. It is retrieving the exact formulas for half-life of mean reversion or covariance matrix shrinkage from your library. It is acting as an interpreter, translating pure academic logic into executable Python backtest. This ensures that your edge is based on robust, peer-reviewed mathematics, not random AI guesses. To conclude, becoming a peer to a quant expert is not about knowing every single formula by heart. It's about understanding structure. When you sit down for that conversation, don't talk about bullish or bearish. Talk about flows. Talk about liquidity constraints. Talk about how regulatory caps on bank leverage create predictable anomalies in the repo market. Talk about how you use Python to model the impact of passive rebalancing. If you can speak the language of forced mechanism rather than speculative opinion, you will not just sound like an expert, you will be thinking like one.